Lemonade's customer acquisition strategy is genius. Stick around throughout this video, find out why. It all comes down to lifetime value divided by the customer acquisition cost. In a few different ways you can kind of think about this, measure this, that we're going to explore in this video, along with comparing possibly what legacy insurers are getting for LTV to CAC and what Lemonade is getting. So if you're not familiar, LTV, lifetime value, you can think of that as what's the gross profit that a customer will generate over their lifetime. And then customer acquisition cost is how much marketing spend does it take for us to acquire one customer. So that ratio of LTV CAC to CAC is super important, and we're going to dive into that. And you can pretty quickly calculate what that gross profit over the lifetime of a customer would be. For the non-math people, just stick with me here. It's really not that complicated what we're looking at. But if you think about a renter who's going to pay on a yearly basis, say $5 a month or $60 a year in premium, and let's say they have a 50% loss ratio, which is roughly around where Lemonade says their renter's product is. So 1 minus the loss ratio would be how much profits are left over. Again, 50%. And then say, for each year, Lemonade right now is roughly an 85% annual dollar retention, meaning for a cohort of customers who are buying renters, 85% of them of those dollars are sticking around year after year. And then on the bottom here, I've divided by 1.04 to the power of n. It just means that factors in the time value of money. And if we calculate that out for this $60, of premiums, it's actually worth about $164 of present value from all the lifetimes of premiums that are going to come from that customer. Now, Lemonade management has said in the past, and this is going back, I think, a couple years ago, I heard them say this, hey, the initial premium, a premium on an annual basis that a customer pays, is roughly equal to their lifetime value. Now, with these metrics, that doesn't really make sense, but if I flip over to here, a different example, say, in the past, this might have been more true even when they were giving this figure, $60 a year renter, $5 a month, and they say they only have an 81% loss ratio, so a worse loss ratio, more losses being paid out, and the same dollar retention, 85%. The lifetime value of that customer is going to be roughly equal to, it comes out 62.4. You could add more decimals and get exactly the number, but it's roughly equivalent. The initial premium, roughly equivalent to the lifetime value of the customer, which is kind of where, just for your own understanding, that's where that has come from. Management sort of interchanging, hey, lifetime value and initial premium that we're getting from a customer. And it is a really good way, an easier way, and we're going to talk about some of that in this video, some comparisons of that, is to think about, rather than trying to dissect the exact loss ratio and retention, even when you're looking at other insurers, to think about more, hey, not just lifetime value of the customer, really thinking about it more as the initial premiums, in-force premium you're getting for a customer relative to the customer acquisition costs you paid to get those premiums. So that ratio, in my mind, as investors, is maybe even a little more user-friendly and a little easier to sort of compare apples to apples. So what is a typical IFP to CAC ratio for legacy insurance companies? It's really tricky to sort of compare across the board because different companies are acquiring customers in different ways. Some are using agents, and the agents may be taking a portion of premiums over a long span of time, maybe the life of the customer. So it's quite complicated to compare, but I did find some information on this. But I did find one study that had looked at the customer acquisition costs for legacy insurance companies, and if it was direct insurers such as Progressive or Geico, it was around $500 per customer, so $487 per customer. And it said for captive insurers such as State Farm and Allstate, a little bit higher, $792, close to $800. And then for companies that use independent agents, it was more like $900 per acquisition. This was kind of the average that I saw listed. Could be as high as $900 per acquisition. So very high actually acquisition amount. Of course, really what matters is how much premium you might be getting to get that sort of IFP to CAC ratio. And if you look up average premiums for car insurance, found in the range of maybe $1,500 a year across the US, could be obviously lower than that, maybe $1,000, maybe even slightly less than that, all the way up to even $2,000 as a rough average. So it's sort of an overall average of in around the $1,500 range. Homeowners insurance could be similar. Some data on Progressive, maybe $1,000 to $1,700, maybe even more. Depends largely on how big your home is, where it is, what state you're in. If you ask ChatGPT, it says home insurance typically $1,200 to $1,500 range, and driving could be even $900 to $1,200 per year. So somewhere in that low end, maybe $900,000 up to $1,500, $2,000 range is going to be the bulk of the policies. And if you quickly get an idea of a ratio of, here, you paid so much for the customer and you're getting so much premium, and how much your premium to customer acquisition. Obviously, there can be a huge range of outcomes, right? So maybe one insurer pays $900 for customer, $900, and there's really terrible payoff because they're only getting about a 1.0 IFP to CAC. And another one's paying $400 or $500 and they're getting $2,000 of premium, so they're getting a 0.1 ratio of IFP to CAC. So I'm going to expect most insurers, the legacy insurers, are somewhere in this range. The best ones, maybe the Geico's, Progressives, are at this 487, and they're getting customers are in this $1,000 to $2,000 range. So the low end, maybe they're getting a 1.8 to 2, all the way up to like a 4 ratio here. So that's roughly what I would guess the very best, and then the very worst are going to be lower than that. Maybe they're only in this range. Maybe they're spending $900 and they're getting $1,500 back, or $1,200, and it's just barely a little bit better. So, and of course, every insurer is going to have a whole spectrum of results. They're going to have one sort of average like this if you really took the average, but every single customer is different, and how they're actually acquired is different. But sort of rough numbers, rough overall averages based on those numbers, those $487 to $900 range. My guess is, most insurers are in the 2 to 3 sort of range, 1 point something, 2 to 3. And some of the very best ones are maybe getting a 3 to a little bit more than 3. What about Lemoande? What is their IFP to CAC ratio, and how can we think about their acquisition strategy? In my Lemoande model, which is available to my Patreon members, if you want to support the channel, feel free to join my Patreon, get full access to the model. I have been tracking their customer acquisition spend and how much IFP they are gaining from that IFP to CAC spend. And I have a graph of it here, and you can see it was roughly in the 2 range for quite a few quarters. We're going all the way back to 2020. And then in more recent quarters, starting around this range, Q2 2022, started to see an increase, 2.5, closer to 3, 2.5, 3, 4.4. If we're looking just at this last year, we had 3, 4.4, and 4.7. Really phenomenal IFP that the whole company is gaining for the amount of CAC that they're spending. I expect that this is going to get better and better because, see, Lemoande's whole strategy is they're acquiring customers in the renters and pet space. These are unloved markets. They're the customers that are spending $60 a month or $60 a year in premium, and then their laptop is stolen. Most insurance companies, they do not want the headache of these sorts of customers. They're useless. Daniel Schreiber, the CEO of Lemoande, he said that insurance companies literally call customers like that when they make a claim a nuisance claim, because say maybe you're paying $60 a year or $100 a year for a renter's policy, and then your laptop is actually stolen, and it's a $500 laptop. They would call that a nuisance claim because their cost of administrating that claim, figuring it out, making sure it's all correct, all the different parts of the business that it, confirm that the claim is true and send out the funds to the customer and go back and forth. They're going to say that actually costs them more than the cost of just replacing or paying for the laptop itself. So legacy companies are just not built. They don't have the tech stack to administrate these unloved nuisance claims and serve these unloved policies the way that Lemoande can. But it's incredible because Lemoande can serve these customers and get anywhere from a 2x ratio up to 3x, maybe even starting to get into a 4x ratio. And you'll notice it starts happening, this trend really starts to happen and take off around Q2 of 2022. And that was an interesting time because if we flip back to the letter for Q2 2022 and I pull up the word Illinois and I flip down to that paragraph, cross-sells and upsells. They closed the Metro Mile transition. They started having more markets that offered car and home. And they even talk about here that the percentage of sales excluding car, so in this graph they're just excluding car even and just talking about everything else. Hey, percentage of sales excluding car that were cross-sells or upsells continue to rise up to 21%, a 2 percentage point jump from the last quarter from 19, 18, 17%, back in Q3 2021. And then they say with car promises to spike these numbers, boom, jump, because we're seeing selling Lemoande car for a few quarters in Illinois. At the time of writing this, they said 36% of all Lemoande sales in Q2 in Illinois were cross-sells or upsells. So instead of 21%, it jumps with car involved up to 36%. Really, really significant. The reason why, if you're not catching this, the reason why you see this trend fairly even, not bad, you're getting, decent numbers, similar to legacy, but they're in a totally different market. They're spending less and then getting a little bit less, they're not spending $500 or $900 and getting $1,500. They're spending, $100 and getting $200 in premium back, or $300 in premium back, or spending $50 and getting a $150 per year renter, that kind of a thing. That's sort of the game they're playing in here. But it starts to take off because of this bundling effect. So now that you have this base of customers, all your base of renters customers and pet customers are starting to slowly upsell and upgrade their products, and you get all this additional premium off the backs of those customers for free. This is the genius of the Lemoande strategy. And these numbers are making sense with what Lemoande has released in the past, even just sort of I think this is be more on a per product basis. So without really considering, I think this would be without considering the amount of premium that might bundle and jump into the policy later. And Lemoande's strategy of going for these unloved customers and then upselling them the products is just so genius, because if they were to compete in the more established products, this is from Investor Day back in November of 2022. They gave an LTV to CAC ratio for home they were estimating 1.6. So not that great, only 1.6 at that time. 81% loss ratio is what they were predicting. Loss ratio was actually worse. They're trying to get that in line. I'm sure it's a lot better now. But LTV to CAC only 1.6. And this is that game, we think about the legacy insurers, this is the game that they're playing. They're playing in that 1 point something, 2 point something, 3 point something possible range of outcomes of LTV to CAC. For Lemoande, it's again, this number is really not that great if you consider, say, hey, they get premiums of $1,500 and they're getting 1.6 LTV to CAC. It means the result is they're probably spending $900 some to acquire one of those customers. So in that ballpark, really roughly estimating this, but in that range of what those legacy insurers were paying for their customer acquisition versus what I've calculated again in my model, their actual overall customer acquisition costs have tended to be more in the $100 and something range. So again, over here was $130, $150, $159, $140, and then in the last few quarters, they've really been pushing more renters and it's a less competitive market, and customer acquisition costs $80, $98 per customer. So significantly less than, say, $500 or $900 that Lemoande acquires one of these customers. And then you have that IFP to CAC effect where it's really those customers start to upsell or bundle their products themselves and get older and have way more insurance, and your IFP to CAC ratio is going to skyrocket. This is why Lemoande, their strategy is brilliant. They're going to keep pushing aggressively to take the renters out of the market, take the pet insurance customers out of the market, and then grow with those customers. And they're not going to be stuck competing for that 1.6 ratio, but they can very attractively command or have, a 2-3 ratio, even just from the renters' pets themselves. And then let alone all those customer base will just grow with the company. And I also did a little bit of math from this graph, or this little bit of data from Q2 2022, where they talked about the amount of their premium sales that was from cross sells only, and it was 21%, 17, 18, 19, 21%, and then 36% with car. And I took that data, went all the way back to Q2. If you just look at this block right here, percentage of sales or upsells, 17, 18, 19, 20 in those quarters. And then I put in the line below it the amount of premium that was gained from cross selling. So for each one of these, I said, hey, for example, Q2 2022, if you look at the equation line, I took the amount of premium that was changed overall between quarters, 39 million, plus I added in the amount of premium that was churned previously, and then you add those together, you get about 58 million of premium, and you multiply that by the percentage that was from cross sales, 21%, and you get that there's about $12 million of premium that was gained in that quarter just from cross-selling. And then if you say, hey, what percentage of that premium that was gained as a function or as a percentage of the total book of business? So if you take that divided by that figure divided by the total amount of premium, you get about 2.9%. So it's hovering about 2-3, and it makes sense that this is sort of similar, is maybe a somewhat consistent number. So at that range without car, it was about 3% per quarter. Your premium is upgrading, or on top of your total, your book of business is growing, just growing 3% per quarter, which is really good. Maybe about 12% per year of IFP growth just from customers bundling together, and that doesn't include car. So the value they gave over here for car was they were more like 36%. So 36%, say that was 36, for example, in this quarter, for example, it goes from 2.9 more to like 4.9%. So you're talking, maybe you get 4 or 5% per quarter, so maybe 16 to 20% per year of IFP growth. It's just bonkers. Purely from that book of business, that base of customers upgrading their products, getting older, buying more products as they become available, et cetera, et cetera. And then another way to look at it, see this is the total premium they're getting, which part of that premium also gets churned away, and then you have to overcome that churn. Another way to look at it is just the overall premium change. And if you look at that on a premium per customer basis, you're getting about, change this back to the 21, about $5 increase in premium per customer on the book of business, meaning, hey, those customers, so on average, those customers are spending about $5 more in premium per customer each quarter, which is, again, is really, really significant. And works out to in that sort of 1.something% quarter over quarter change in premium per customer. Again, if this was much higher, like 36, then you could be closer to maybe even 3% per quarter. So a really significant amount of growth Lemoande is going to get simply from customers bundling and upselling there into other product lines that are much more valuable. And this is where I want to end the video off and hopefully just hammer this point home for you, that this is really, really a genius strategy that's really is only unlocked for Lemoande because they have this tech stack that allows them to automatically sell policies, administrate policies, pay claims on policies in a hyper efficient and hyper scalable way, especially for these unloved products. That's the only reason they can do it, and other insurers can't just quickly go, oh, we'll just copy Lemoande and jump into the renter space. They can't compete in that space. And this is starting to jump up here, but then if you look ahead at my model, you can see where we're at right here, 2024 Q1, we're in the 4 range. But I see this ratio of CAC spending and IFP gaining because that book of business is going to keep, they're growing that lower renter pet base, and that's going to keep expanding. That ratio, I see it going up to even 10, 11, 12. In my mind, that's where this ratio is headed. They're going to be super effective at getting premium. I hope this makes sense. Let me know down below in the comments what you think. Of course, if you're interested in Lemoande, I encourage you to build your own conviction and take nothing on this channel as personal financial advice, because none of it is. But thank you so much for watching, and remember, it's in the bag.